Imagine three Australians sitting at the same desk, earning the same salary, paying the same rent, living in the same city. They all save the same amount every single month. But 30 years from now, one of them will barely scrape together enough to retire. Another will be comfortable but always wondering if they could have done more. And the third will have built real generational wealth. The only difference between them is not how much they earned, it's how they chose to invest. And today, I'm going to walk you through all three paths so you can see exactly where each one leads and figure out which investor you're becoming right now, whether you realize it or not. Let's start with the conservative investor. We'll call this path the safe road. At age 25, this person gets their first serious full-time job earning around $70,000 a year. They're careful with money. They don't like risk. The thought of losing even $1,000 in the stock market makes their stomach turn. So they do what feels safe. They stack cash into a high-interest savings account earning around 5% per year. And they leave their super in a conservative option, which is mostly bonds and cash, averaging about 4% to 5% per year after fees. On paper, that sounds reasonable. The money is protected, it's insured, it's predictable. And that predictability is exactly what makes it feel like the right move. Every month, they put away $500 into savings. Solid discipline. No complaints there. But here's where the math starts to sting. After 10 years, by age 35, they've saved roughly $77,000 in their savings and term deposits. Their super sits at around $90,000. They feel good. They feel secure. But inflation in Australia has averaged about 3% to 4% recently, and with the RBA cash rate now at 4.10%, their real returns after inflation are barely 1% to 2%. That means their money is growing but just barely keeping up with the rising cost of living. Think about that for a second. You're saving every month, doing the responsible thing, and your purchasing power is almost standing still. A dollar you saved 10 years ago can barely buy what it used to. Fast forward to age 45. They've got maybe $190,000 in savings and their super is around $250,000. They start to notice something uncomfortable. Their mates who invested differently seem to be pulling ahead. By the time they hit 60, they've accumulated roughly $500,000 to $600,000 total between savings and super. Now, the Association of Superannuation Funds of Australia says you need around $630,000 as a single person to retire comfortably, so our conservative investor falls short. Every dollar is accounted for and there's no room for surprises. That's the cost of playing it too safe for too long. Security became a cage. Now let's look at the moderate investor. Same starting point, age 25, earning $70,000. But this person is willing to accept a bit of discomfort for a better outcome. They split their money. They keep an emergency fund of 3 to 6 months of expenses in a high-interest savings account, but everything above that goes into a balanced portfolio. They buy ETFs like Vanguard's VDBA or a mix of VAS and VGS. Their super is set to a balanced or growth option, targeting around 7% to 8% per year after fees. They also invest that same $500 a month, but instead of letting it sit in cash, they dollar cost average into the market. That means they buy in every single month regardless of whether the market is up or down. Some months they get shares at a discount. Other months they pay a bit more. But over time, the average cost smooths out and they avoid the trap of trying to time the market perfectly. After 10 years at age 35, their investment portfolio has grown to around $95,000. Their super is sitting closer to $120,000. One thing worth mentioning is that the Australian share market has returned about 9% to 10% per year on average over the last century when you include dividends. So the moderate investor is actually riding the long-term trend of the entire economy. By age 45, they've got around $300,000 in investments and $350,000 in super. They start getting options. Maybe they use some of that equity to put a deposit on an investment property, especially with median dwelling values in Australia now sitting around $900,000 to over $1 million depending on the city. Or maybe they just keep compounding and let the maths do the heavy lifting. At 60, the moderate investor is looking at $900,000 to $1.1 million across super and investments. They can retire without stress. They have choices. They can travel, help their kids, or simply stop working because they want to. That gap between them and the conservative investor is now hundreds of thousands of dollars, and it all came from the same $500 a month. The only thing that changed was where they put it. Now let's talk about the aggressive investor. Same salary, same age, same starting conditions. But this person thinks differently. They understand that time is their single greatest asset and they refuse to waste it. At 25, they go all in on growth. Their super is set to high growth or aggressive, targeting 9% to 10% returns over time. Outside of super, they invest heavily in diversified growth ETFs, like VDHG or DHHF. They might also allocate a portion to international shares through VGS or even sector-specific funds. They're investing that $500 a month, but as their income grows, they increase it to $750, then $1,000. They also salary sacrifice into super, getting closer to the $30,000 concessional cap and saving on tax in the process. After 10 years, by 35, their portfolio is around $115,000 to $130,000. Their super is pushing past $150,000. But here's what most people miss about aggressive investing. It's not just about returns, it's about behavior. This person lived through market dips and didn't sell. They watched their portfolio drop 15% in a bad quarter and they bought more. That emotional discipline is what separates wealthy people from everyone else. Most people panic when they see red on the screen. They sell at the bottom, lock in their losses, and then watch the market recover without them. The aggressive investor does the opposite. They see a dip as a sale, and that mindset alone is worth more than any stock tip you'll ever hear. By 45, the aggressive investor has roughly $500,000 to $600,000 in investments and $500,000 or more in super. They might own an investment property on top of that, and the compounding is now doing most of the work. Their money is making more money than their job pays them. That's the tipping point. The moment your portfolio earns more than your salary, you stop working because you have to and start working because you choose to. At 60, this person is sitting on $1.5 million to $2 million or more. They didn't win the lottery. They didn't inherit a fortune. They invested $500 a month in their 20s and let compound interest turn it into a machine. Now here's the part nobody talks about. All three of these investors made sacrifices. All three saved money consistently. All three showed discipline. The difference was never about effort. It was about allocation. Where you put your money matters more than how hard you work to earn it. And the irony is that the path that feels the safest, the conservative one, actually carries the biggest risk of all, the risk of running out of money when you're too old to earn more. I'm not saying everyone should go aggressive. If you're 5 years from retirement, that's a different conversation. But if you're 25, 30, even 35 with decades ahead of you, your biggest danger isn't a market crash. It's sitting on the sideline while inflation eats your savings alive. The super guarantee in Australia is currently 12% of your salary. That's a start, but it's not enough on its own. The contribution cap sits at $30,000 for concessional contributions right now, rising to $32,500 from July 2026. Use it. Max it out if you can. Every dollar you put in before age 40 has the potential to multiply 6 to 8 times by the time you retire. If this hit home, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.